Welcome to our explainer. Today, we are talking about a massive story that's been brewing for decades. We're talking about Japan's debt crisis. And trust me, its final chapters could have a very real impact on your money.
So let's just dive right in with a pretty big question. What if a financial story that started 30 years ago, way over in Japan, is now sending tremors so powerful they could actually shake up your portfolio? Because, well, that's pretty much exactly what's happening as we speak.
To really get what's going on, we have to meet our main character in this story, the Japanese economy. And you can think of it like a giant that's been fast asleep on a huge, and I mean huge, mountain of debt.
For decades now, Japan has just been piling on more and more debt. It's now reached a staggering 250% of its entire economic output. To put that in perspective, that's like you earning $50,000 a year, but being in debt for $125,000. It's a lot.
And just to really hammer that point home, let's compare it to the US. The US debt to GDP ratio is sitting around 120%. Now, most folks would agree that's already really high, but it's less than half of what Japan is juggling. So you're probably asking, how do they manage this for so long? Well, for 30 straight years, Japan kept its interest rates at basically zero. Yep, zero. This policy essentially created free money for anyone who wanted to borrow it. It kicked off this huge global investment strategy that everyone just assumed would last forever. But now, that 30-year slumber is officially over.
So how is this all starting to come apart at the seams? Well, after 3 decades of quiet, the giant is finally waking up. And the very people who have been funding this massive debt, we're talking about the bond market, they are getting really nervous. And this is where the plot really starts to thicken. Japan's new prime minister, he wants to push through a massive new spending bill to get the economy going. But the bond market, the investors who actually lend the government its money, they're starting to push back. They're basically saying, no, we don't think you can afford this. So even with all these public promises to manage the finances without taking on more debt, the market just isn't buying it. And their reaction, selling off Japanese bonds like crazy, is what's causing the ground to shake, not just in Japan, but everywhere. Okay, so this is the crucial part. How does a problem in Japan become your problem? It all comes down to something that, for years, worked like a magic money glitch for investors all over the world.
For years, the game was incredibly simple. Big investors would borrow money in Japan for basically nothing, since the interest rate was zero. Then they'd swap it for US dollars and buy US government bonds that paid out, say, 4 or 5%. It was almost a risk-free profit, and it created this giant river of money flowing from east to west.
But the scale of this is just mind-boggling. We're not talking about a small trickle of cash. Hedge funds saw this free money and used leverage to amplify it into a colossal $20 trillion trade. Just to be clear, that is more than the entire yearly economic output of the United States. It's massive.
But now, the glitch is gone. With Japanese interest rates finally going up, the math just doesn't work anymore. That easy profit margin, it's vanished. And that $20 trillion river of money is starting to flow violently backward as all those investors scramble to get out of the trade. And this is where the story lands right in your backyard. This isn't just some abstract thing about global finance, it's about the stuff you actually own, from the stocks in your 401k to your retirement fund. So why should you care? Well, think about it. When those hedge funds have to unwind that $20 trillion trade, they have to sell their US assets to pay back those Japanese loans. And they don't just sell one little thing. They sell their best, most liquid stuff first. US bonds, big tech stocks, maybe even crypto. They sell it all at once. And that selling pressure drives down the value of the very things you might be holding in your own portfolio.
And hey, don't just take my word for it. A top investor, Ken Griffin, is warning that in this type of crisis, all the old rules of investing just kind of break down. The things you thought were safe havens might not be so safe anymore.
Now, this right here is probably the most important thing to understand. It's called a correlation breakdown. The old school thinking was that you own stocks and bonds, so if your stocks go down, your safe bonds go up and act like a cushion. But in this scenario, where these giant funds are forced to sell both stocks and bonds at the same time to raise cash, well, both can fall together. That cushion completely disappears. Your hedge is gone, and your portfolio is exposed on all sides.
So all of that sounds pretty serious, I know, but this is not about panicking. It's about being prepared. Understanding the risks is step one.
Now, let's take a look at what the source material suggests for building a stronger financial arc to weather this kind of storm. The whole focus really shifts towards quality and things that can last. So you're looking at defensive sectors like energy or consumer staples. Companies that make stuff people need no matter what. The high-risk areas to be wary of are the ones that are really sensitive to high interest rates and people pulling back on spending. Think regional banks or luxury goods.
So what are the actual warning lights you should be looking for on the dashboard? Well, the source material points to a few key numbers. Keep a close eye on U.S. government bond yields. If the 10-year yield starts creeping above 4.5% or the 30-year crosses 5%, that's a huge signal. Those levels suggest that the pressure from this whole unwind is getting severe, and it could force investors to sell even more aggressively.
In the end, every story has a moral. This one isn't over yet, but I think the lesson is already pretty clear. Knowledge is your absolute best defense. By understanding the story of this sleeping giant, you're just that much more prepared to protect your own financial future no matter what happens.